Hey everyone, and welcome. So today, we're going to tackle a term you hear thrown around all the time in finance: beta. It's probably the most common way to measure a stock's risk. And by the end of this, you'll know what it is, how it works, and maybe most importantly, where it falls short. Let's dive in. When you're looking at a stock, you're really asking one simple question. Is this thing going to be a wild roller coaster, with incredible highs and those stomach-lurching drops? Or is it more of a calm, scenic railway, just a nice, steady ride? It's really the classic question of risk versus stability. And believe it or not, there's actually a single number that tries to answer that question for you. It's kind of like a cheat sheet for a stock's personality. Does it love drama, or does it prefer to keep things chill? Okay, so let's get down to brass tacks here. The problem we're trying to solve is how to measure a stock's volatility. But, and this is the key part, not just in a vacuum. We need to measure it compared to the entire market. That comparison is everything. And look, this isn't just some abstract financial theory. If you're building a portfolio, this is super practical. You gotta know if adding a new stock is like adding a stick of dynamite or a nice, heavy sandbag to your investments. That's exactly where beta comes into play.
All right, so let's finally pull back the curtain on this mystery number. It's time to actually define beta, which is pretty much Wall Street's go-to benchmark for volatility.
To put it simply, beta is just a score. It tells you how much a stock's price tends to bounce around compared to the overall market, something like the S&P 500. It's all about relative motion. Okay, this right here is the absolute key to understanding all of this. We have to have a starting point, right? So, by definition, the market itself, the S&P 500, has a beta of exactly 1.0. That number is our anchor, our yardstick. Every single stock gets measured against that 1.0. So, we've got our anchor. The market is 1.0. But what about all the other numbers? What does it mean if a stock has a beta of 1.5 or 0.5 or even a negative number? Let's break down the code. This chart makes it super clear. See a beta over 1? Think of your high-flying tech stocks. They tend to exaggerate the market's moves. So if the market pops 10%, they might jump 15%. But yeah, that works on the way down too. A beta under 1 means it's less volatile. Think of a steady utility company. And then you get the really interesting stuff, a negative beta. These are things like gold that often zig when the rest of the market zags. Okay, so reading the numbers is one thing. But how do you actually use this in the real world? Let's talk about how beta actually works as a tool when you're trying to build a balanced portfolio. I want you to think of the whole market as a giant ocean wave. That wave is what we call systematic risk. It lifts and drops all the boats. You can't really escape it. What beta tells you is what kind of boat is your stock. Is it a tiny little speedboat that gets tossed around like crazy? Or is it a huge tanker that rides out the wave a lot more smoothly? And at the end of the day, it's that classic balancing act between risk and reward. A high beta stock is like strapping a rocket to your portfolio. It's awesome when things are going up, but it can be really dangerous when they're not. A low beta stock is more like an anchor. It adds stability, but it might hold you back from those huge gains. All right, now for a super important reality check. Beta is a really cool tool, but, and I can't stress this enough, it is not a crystal ball. It has some major limitations that every single investor needs to know about. So the logic seems pretty simple. If you want lower risk, you just load up on stocks with a low beta, right? Problem solved? Well, it's a really common trap, and it's not quite that simple. And this quote right here just nails the single biggest misunderstanding of beta. A stock can have super low volatility, a low beta, while it's in a slow, steady, consistent decline. It's not jumping around. It's just bleeding out day after day. Beta only sees the fact that it's not jumping. It doesn't see the massive losses. Does that sound low risk to you? So let's be really clear about beta's blind spots. First, and this is huge, it's like driving by looking only in the rearview mirror. It uses past data, which is no guarantee of the future. Second, beta knows absolutely nothing about the actual business. Is the company profitable? Does it have a great new product? Beta has no clue. And finally, a company's beta isn't set in stone. It can and does change over time. So, after all that, what are the most important things to lock in your memory about beta? Let's just boil it all down to the final takeaways. Here's how you should think about it. Beta is one tool in your toolbox. It's a measuring tape. It tells you how a stock's past volatility stacks up against that 1.0 market standard.
But that's it. It's backward-looking, and it's a very incomplete picture of what risk actually is. It should never be the only tool you reach for.
And that really leaves us with the big question, doesn't it? Beta gives you a pretty clear picture of how a stock behaved in the past. But the real challenge and the real job of an investor is to figure out what it's going to do in the future. And that is where the real work begins. Thanks for tuning in.